Hello and welcome. Thank you all so much for coming. This is the minimum wage webinar brought to you by the West Business Development Center. My name is Clara Shook. I'm the event coordinator with the West Business Development Center. And for those of you who may not be aware, the West Business Development Center is a nonprofit funded by the Small Business Administration, the SBA, a federal organization, and we host two centers. We host the Women's Business Center and we host the Small Business Development Center for Mendocino and Lake County. West is funded through federal, California state, and local government grants. In exchange for these grants, we provide free confidential business services. Our goal is to provide these business services to entrepreneurs and small business owners during every stage of business development. So whether you're just starting out with a part-time hobby or an idea, or you've been in business for many, many years, we want to be here to provide resources and assistance to you in running your business. Now, we do this through our no-cost one-on-one counseling. We have a wide variety of very talented advisors who can help you from anything from marketing, accounting, HR, taxes, which are coming up. We run pretty much the whole gamut, and we can have someone help you personally because not every single business is unique. Not one is alike. We also offer low-cost workshops and free webinars like the one you're at today, as well as loan packets and loan readiness services. So if you're getting ready to apply for a small business loan or you've taken out a small business loan, in particular, I'm thinking of folks who may have taken out a PPP or EIDL loan. And if you have questions, please come and see us and we can help you with that process. And that's basically how our funding is used. If you'd like to learn more about West and taking advantage of our services, please reach out either through our website and the Get Started button there, or you can also call us on the phone and we can help get that process started or answer any of your questions that way. I do want to let everyone know that we are recording today, and I will be emailing a link to the recording as well as a copy of the slide deck out in the next couple of hours after the workshop. So just keep your eye on your inbox for that email, which will come your way. I also want to let everyone know that we will have a poll at the very end of this workshop. So I highly recommend that you stay to the very end of the presentation and help us answer those poll questions. These poll questions are really important to us because not only do they help us find out what you, the small business owner and entrepreneur, are looking for in your next workshop, these poll questions are really important to us maintaining our funding so that we can keep providing these free resources. So that's all for now. Without further ado, I'd like to introduce our amazing instructors today, who are also our business counselors with West Business Development Center. We have Steve Lamb and Kevin Williams. Take it away, guys.
Great. Thank you, Clara. My name is Kevin Williams. I am a business advisor with West Business Development Center. I'm responsible for the coast and for Lake County. And I just had my 3-year anniversary. I just didn't even realize it occurred. It was on December 1st. So I've been here for 3 years and working with clients all along the coast, as I said, and also in Lake County. And I just wanted to welcome all of you to today's event. And I'm going to turn it over to my counterpart, Steve.
Thank you very much, Kevin. Clara, thank you very much. Kevin and I both do the same thing. I do this along the 101 corridor from Hopland up to Laytonville and over to the Boonville area. And been doing this, I was a client first in 2011 and then was asked to come on as a consulting advisor and then became an employee in 2016. And to be honest with you, it's the best job I've ever had. But the reason we're here today, we're going to be talking about the minimum wage. And let me pull up the workbook you're going to be getting. This is year 3 going into year 4. And this is really starting to take its toll on businesses in California. The obvious toll, of course, is your internal labor costs. But what's not so obvious is you're getting increases from your vendors, not only the vendors that you buy products from or services from for resale, but also your operating expense vendors, including PG&E, sewer, and water. They are getting the same increases you are with regard to labor, and they're passing them on to you. And what we're doing right now is taking a look at this, and we're getting pretty close to the end of this. This all ends when minimum wage is at $15 an hour. And we want to make sure you as business owners are prepared for what's going to be happening. And that's the true purpose of this webinar.
Okay, great. Thank you, Steve. All right, so before we start, just a few things for you to know. We'll be going through the 2021 Income and Expense Workbook. This is a simple fill-in-the-blank report that will quickly record your financial status today, then allow you to map out where you will need to be in 2021. Each tab has complete, way easy to follow instructions. Just so you know, there is no minimum level of Excel knowledge necessary. We have included 2 YouTube links for anyone not new to Excel or would like a quick refresher. This is an entry-level webinar on determining your financial position. If you are more advanced, this workbook will serve to reinforce your confidence. This workbook was created as generic as possible for ease of use by any types of business selling products and/or services. This webinar is being recorded, as Clara said, and will be available to you as needed to review any part when you are completing your workbook. And then, of course, Steve and I will be available to you after the webinar if you have any questions when you enter your data. And with that, I'm going to turn this back over to Steve.
Thank you very much, Kevin. So here we are, California Fair Wage Act of 2016. This is broken up into employer groups, Tier 1 and Tier 2. Tier 1 are employers with 26 employees or more. Tier 2 are employers that have 1 to 25 employees. And to be quite honest with you, that is the majority of our clients. They fit into Tier 2. I'm not going to spend a lot of time here other than if you're Tier 1, you're at 13 today. If you're Tier 2, you're at 20. Tier 1s are going to 14. Tier 2s are going to 13. It's a big jump. If you're talking about a minimum wage employee who's working 40 hours a week, then we're talking about an additional $2,040 just in compensation increase for the year. In 2024, the minimum wage becomes indexed, and all that means is that the state legislature each year will take a look at it and has the option of applying a consumer price index increase to it. And it's called the CPI increase. For the last several years, it has been either touching 1% or as high as 1.1 to 1.2%. No guarantees what's going to happen in the future. Nobody knows. I know this has been a heck of a year to go through. But I don't know what that's going to do to CPI. But starting 2024, hopefully everything will be leveled out and we'll be looking at very minuscule CPI increases. I'd like you to make a mental note that when you get this, you look at point number 2, wage compression. We're not going to talk about it, but I want you to be aware of it. Okay, so this is how this is pretty much laid out. Everything is color-coded. We're looking at expenses and whatnot. And we have brought these out in different colors. This is actually the first place we're going to start entering any information. And we'll do that in a second. First thing I'd like to do, though, is hand this over to Kevin real quick with regard to minimum wage itself when it hits in January and some of the things we run into.
So one of the reasons that we've decided to do this webinar is we often find at the beginning of the year that people, business owners, are surprised that the minimum wage has gone up. Obviously, most of the time, the holidays are some of our busiest times of the year from our business, and it's easy to forget. So we just wanted to reinforce with everybody that it will be going up in January, and to offer this tool to help people work through the process of deciding what they're going to have to do to be able to continue being in business and pay that higher minimum wage. So we'll let Steve get started on the process.
Thank you very much, Kevin. So data entry, and there is data entry in this workbook, is all done in gray shaded cells. But it doesn't mean if there's a gray shaded cell that you have to put something in there. It is put together specifically, as Kevin said earlier. It's a very generic tool for you to use, and different people will be entering different items and may not be using all of the data entry cells. If you come across a cell that has a red triangle in the right upper corner, there is some kind of information in there or an instruction. And to figure out what it is, just put your cursor in there and a little bubble will pop up with that information. And with that, start here is where we put our first information in. We're using Bob's Big Boy Boots as our test business today. And the period that we're using is going to be November 20th. I'm sorry, November 2020, since that's the month that just ended.
Okay. So what we do recommend that you track your pricing and expenses on a monthly basis, and you can do this through your bank accounts, your invoicing, your monthly invoicings, and billing. So just keep that in mind. This is really something you want to track on a monthly basis, so you keep a good handle on it.
Thank you, Kevin.
Steve?
Okay. Expenses. Everybody loves expenses. So there are three types of expenses that a business deals with. We're only going to be talking about two of them. The two we're mainly going to be talking about is going to be variable expense. These are the expenses that we incur when we purchase an item for resale and then sell it. The other one is fixed operating expenses. And fixed operating expense is, that's our overhead. And we're talking about our rent, utilities, internet service, cell phone service. Those things we have to pay month in and month out to keep the business operating. And some people have a little bit of an issue with regard to trying to figure out, well, is this a variable expense or a fixed expense? And here's our first bubble. A variable expense, in case you can't read this, I will read it out loud. For a shoe store, when a pair of shoes is sold for $30, the purchase price is subtracted from the cost of buying the inventory, which was $12. The resulting $18 is contributed to gross profits. The $12 in COGS expense is realized when the sale is made and entered in the monthly P&L statement. So you'll hear business advisors, financial people and whatnot, they're talking about, okay, well, a variable expense is something you only have when you sell something. In other words, you've sold inventory. And that's when you're actually paying for it on the books. And so you're asking yourself, what kind of expense is this? Well, the only time I incur a shoe expense is when I sell a pair of shoes. And so that's a variable expense. A fixed expense. Examples of overhead expenses include, like we said, rent, utilities, internet service, and these have to be paid regardless if you sold anything or not. If you sold nothing, you still have to pay it. That's a fixed expense. Now, the standard layout for P&L structure, very light. This is just an example, $1,000 in sales minus the cost of those sales, $250 gives us our gross profit. We take our gross profit and that's what we're paying our overhead expenses with. And then hopefully we've got something left over and that's going to be our net profit. And we're going to do certain things with that. We're going to be paying back loans. We're going to be reinvesting back in the company. I've got to update my computer with new software. We're going to be putting some money aside for a rainy day, which we've had quite a few. And also the most important thing about profits is it measures the ability of the owner of that business. How are they performing as the owner of that business with regard to how profits are handled? So, Kevin?
Yeah. So I just want to reinforce that we're only talking here about variable and fixed expenses, and we want to keep the capital expenses out of this formulation because those, if you include capital expenses, you can start to skew your pricing structure and actually end up raising your prices more than you need to. And so just make sure that you do not include capital expenditures when you're working through these formulas. Just wanted to reinforce that.
Thank you. Okay, COGS, cost of goods sold. Standard business term, COGS and cost. Cost is cost of services sold. So this is what Big Bob sells. He sells these items here. This is what he's paid for them. And this is how many he has sold of each varietal with regard to the month of November. And so all we're really looking at is for the month of November, he sold $15,178 worth of inventory for a total of 1,093 pairs of boots and an average cost of $13.89. And this is how this is broken up. We have 2 sections in expenses, and you'll see 3 sections further on. But now we're looking at proposed. And what this is Big Bob's vendors have said, listen, we're going to be increasing the cost of the boots we sell to you by 25 cents a pair. And hopefully in the written letter or email or however he received this information, they told him, we're doing it because, well, our labor is going up because of the minimum wage and we're having to pass that on to you. And as a result, Big Bob's pricing is going up. Now, this is where retailers can get in trouble. They want to absorb this cost and try to keep their prices low to keep their sales going. I can understand that if this was an expense that's only hitting you, but it is hitting everyone in the state of California. And you've got to pass these expenses on. You have to if you're going to stay in business. And that's the other purpose of this workshop, is to show you how to do it, but how to do it in a way that you're not gouging and you are also staying up with your competition. If your competition doesn't pass these on, they're not going to be competition for very long. Yeah. Okay. Kevin?
Yeah. So once again, cost of goods sold and cost of services sold. But what if you're a business that is involved in both? For instance, a plumber. You have a service and you're also selling products, maybe fittings or whatever to fix a specific problem. That combined cost is called cost of sales, and it's a little bit different. But and when you are doing that, you want to make sure that you include your payroll costs for labor, payables, liabilities, and benefits. You want to include all that in the cost. So it's a little bit different nuance. Not everybody is just simply selling a service or simply selling a product, but a combination of the two, as we said with the plumber. So once again, if you're in that kind of a situation, then this is cost of sales that you're going to be looking at.
Thank you.
Next tab, Steve.
Okay. Fixed expenses. Okay. We've got a lot of gray here. We've put these labels in. They will, when you get your workbook, these labels will still be in there, but the numbers will be gone, of course, because they're not your numbers. You can override them. You can leave them there. You can add on to them at the bottom and just whatever you want to do. The only thing that's actually frozen in here is going to be the payroll expense line. And that's to ensure that when you're doing your labor, it automatically transfers back into your fixed expenses. And again, we have that same layout. This is what Big Bob's business looks like today on his fixed expenses. And these are the notices he's received from the bank, from his internet provider, with regard to office supplies, with regard to the garbage company, and with regard to, he was looking at his contract for his lease, and it goes up $75 on January. So that's where the increases are coming from. They're not part of this yet. This section is in here for you to know, what are my expenses going to look like when this all happens? Kevin?
Great. So just a couple of clarifications here. I'll point these out, that the business credit card and the line of credit expenses are entered but not long-term expenses. And long-term expenses are those things where the payback is over a year, and that's a loan, for instance, and the payback is over a year on it. Then that is not included here because that kind of debt is paid out of profit. So it's kept separately. So just make sure that if you have any kind of debt like that, loans, for instance, where the payback is over a year, you want to exclude those from this.
Perfect. Okay. So now we're going to go into the area that a lot of people do not like, payroll. And it is confusing. It is complicated. If you're doing it yourself, you already know, or you're paying somebody to do it, either a contractor in the way of a full service bookkeeper, or you're using ADP or some other payroll service, and it can be complicated. However, this is probably the easiest part of the entire workbook to fill out. I'm not going to go into all of this stuff here. These are very simple instructions. The one thing I will say is that as you're entering, everybody has to be put in with regard to an hourly wage. Now, if you're an owner and you're taking owner's draws, it's almost like a salary. There, in this tab here, it is explaining how you convert that into an hourly wage. So let's jump into it real quick. And let's see here, year one. So Big Bob's already put his name in here. And what we've got here, got Big Bob. He has one salesperson, and he has somebody that runs his stock room, 3 employees. Big Bob pays himself $20 an hour. He pays his salesperson $15 an hour, and his stock person $12. And the last entry on this, believe it or not, is just going to be hours. Big Bob works 24 hours a week. His salesperson works 40, and his stock person works 20. It's done. That's all that's needed. From a straight labor expense, $5,720 a month, fully loaded with regard to payroll taxes, is $6,294. That's all that's done. There are several red triangles you'll see here. Some of these are from the creator of this payroll tool, and this actually comes out of SBA's SCORE financial projection workbook. And this is what you would use if you were building a business plan to go to a bank to ask for a loan. This is the tool out of it. And very, very simple, very, very direct. It already includes the mandatory 24 hours of sick leave for employees. That's in there. One word of caution, this is in the instructions. With regard to your employees, you are paying workers' comp. So go to, if you already know what that cost is, enter it. If you don't know, talk to your payroll person who is doing your payroll. And in the instructions has the password for you to go in and overwrite any of these sections in here. Right now, it's not in. If you go to enter something, well, I take it back. It is open. If you go to enter anything in here, you're going to get a prompt like this is saying it's password protected. Year 1 and year 2 are the only 2 worksheets that you'll have the password to. And then make sure that after you change it, you put the password back in to protect it. Otherwise, the formulas are open and you could accidentally hit a cell and hurt it. With regard to the year 2 tab, it's exactly the same. The only thing that has to be updated here is just the hourly wage. And Bob is going to go to $20.50. And his salesperson is going to $15.75, and of course his minimum wage employee is going to $13. There's the new numbers. Now he's decided that his stock person is worth more than $13 because he's given him some extra work, and he's going to move him to $1,200 a month. And you just overtype that in, and it changes it. That's all you've got to do. Okay. So now that we've done that, we're going to run back into fixed expenses, and you can see that those lines have now been populated. There's his current payroll. There's his proposed payroll. Not really proposed, that's what it's going to go to. And this is what the variance is. This is the addition to it.
Great. Thanks, Steve. So just to reiterate, now this area is populated, but once again, this is why you want to make sure that you keep these areas password protected, because you don't want to lose these formulas, like the formula Steve just filled out the document, came back, it filled this in. You want to make sure that those are preserved and not altered in any way, shape, or form. So that's why it's important to keep these things protected as much as possible. So.
And if you're new to Excel, when you get into a cell, when you look up in this window, that's a formula, equals G10. And it's basically saying equals this cell here. If you're experienced in Excel, that's something that your eye automatically sees. If you're new, you'll start doing that, and it just becomes an automatic response to look at that window. Okay, so pricing structure. This is where we pick up something new, and this is Big Bob's his pricing. You notice that this carried over from his COGS sheet. It automatically imported it and dropped it in, along with his current price. The only thing he's doing right now is he is entering what he charges. This is his retail pricing. So if we look at the first item, he buys it for $12.75 and he sells it for $19.95. And that's his profit, $7.20, with a gross profit margin of $36.09. Now, up here, we've got this little piece up here. We're showing the current margin, $36.98, and the current markup. And the margin is an external number we use. Everybody uses it, CPAs, lenders, everybody looks at margin. Markup is more of a internal tool. And Kevin's going to speak a little bit about that in a couple of minutes. But what the most important thing for you to know is that as a retailer, you're sitting in the retail sector, but you have your own industry. And Big Bob is part of the footwear industry. And so if you go over to this box here, a little thing pops up and it shows the average gross profit margins for retailers. And let's see, for Bob, it's 44.3. So, and he's a little bit under. He's really underserving himself. So all we're going to do is we're going to put in 44.3 in here, and that's going to tell him where he should be. And that's where this industry margin part comes in. So what we're looking at is he had entered $19.95 and he should actually be selling it for $22.89. And as you can tell from here, that's strictly just for Bob. We've got a person attending today that works in the pet industry, and that person has a totally different one, 43.6. We might have somebody that is doing baked goods, 56.5%. So if yours is not listed here, that's fine. A real quick internet search will bring this up. I did a couple the other day, and in 1 minute, I had close to every retailer type that we service. And it was a list of about 200 different retailers and what their average gross profit margin is. And that's all there really is to this. And if you'll notice, right up here with regard to his current margin and his current markup, when we put in the new one, it basically said this is what the markup is going to be. But Kevin's going to talk a little bit more about that.
Yeah. So just so you know, when you get the workbook, there'll be a link for an article about the difference between margin and markups. And while markups are very important for you in terms of how you're going to price things, margins, as Steve alluded to, is really what is looked at if you're going to go for a loan, for instance, or you want to sell the business. Folks are going to look at the margin. What kind of money are you making on this? That's much more important to them than the markup. So just keep that in mind, that there is a definite difference between the two. Excuse me, and sometimes people get that confused. But once again, we do have a link for a short article on it. But the margin is your profitability. And that's the item that is most of interest to people who are going to loan you money or buy your business and so on. So Steve?
Okay, good. Thank you very much, Kevin. So we're going to jump over real quick into pricing proposed. What we have here is we've got the updated pricing from our last sheet. So as you saw, he was at $19.95 when he put in his new profit margin. It brought him up to $22.89. And now we're using that as the basis to look at the proposed increase coming in from his vendor. So the vendor, remember, he was selling at $12.95, and his vendor, $12.75. And now with the increase, he's going to have to start buying at $13. And that's what we're doing here. Oh, okay, the COGS price is going up, and now we're applying that new margin of 44.3% against that $13, and we have a new suggested retail price of $23.34. Now, Kevin and I are not here to tell you this is what you need to do. You own the business. It's your decision. What we're trying to give you is information and options. You've got what you're selling it for now. You've got, which was, if you were Big Bob, it was $19.95. And this is what the suggestion would be from his industry. He should think about selling it at $22.89. And then when this increase comes in, $23.34. Now, one of the things that's really important is that you know where your competitors are. And the whole thing is in a way, you end up with that little magic tool here with, you know what your costs are, you know what your selling point should be. And when you know where your competitor is, you can pretty much tell what's going on. He's going to have pretty much the same expenses for you. The only difference may be lease cost or something like that. If he owns the building, he's paying a lot less than you are. But you know what he is selling at, and you know where it fits into that. But on top of that, there's some other issues with regard to that, and Kevin's going to talk to you about that.
So just to be aware, if you go through this process and you find that you're going to have to raise your prices considerably, that becomes a marketing challenge for many people. And so if that does occur, you can contact Steve or myself, and we can work with you, and if necessary, assign a marketing person to work with you to make this happen. The other thing I would just say is this: if you keep track of all this, including the wage increases on a regular basis, you should not have to see necessarily big jumps in your pricing structure. There was a business here on the coast a couple of years ago that tripled their rates all at once. And, I don't know the business personally, but you just know that they weren't keeping track of their expenses. And then all of a sudden it was like, oh my gosh, I've got to increase my rates right now because I'm not making any money. So you don't want that to happen to you. So the closer you can keep tabs on these kinds of pieces of information, the better off you are. But if you do find yourself coming in really high in particular because of some of this work, then if you feel like you would like to create some strategies around how to introduce that to your customers, then please contact us.
Mm-hmm. I just want to tag on to that. We had a client, still have the client over here in Ukiah. And 2 years ago, this was all hitting him. He's a tier 1 employer, so he was getting that $1 increase faster than a tier 2. And there was a little bit of panic, but we sat down and put a plan together, and he needed to increase his prices almost 25%. That is a big hit. But what we did was we were looking at doing little pieces during the year. And what happened, by the end of the year, he was right where he should have been. Did he take some losses? Yes, he did in the beginning of it, but he was able to weather through that. And then when he started the next year, it was a very simple increase for him to move forward. But he had ignored his pricing for a while. And then all of a sudden he found he did not want to be like the client Kevin was talking about on the coast. He was in a very competitive market, and he could already see what was going to happen to him. So there are ways of doing it. It seems like a huge mountain to climb sometimes, but that's what we help you with. Those are some of the things we do, is we will sit down with you, and we have some very, very good marketing people. This is what they do professionally, that are our advisors, that will help you put these marketing plans together to see that through. Okay. So sales, this is the result of what's happened. We're looking at our retail pricing. We're looking at the, with regard to what Big Bob was doing, his current retail, his sales. We're looking at the updated part. This is just getting him into the profit margin that is the average profit margin for his industry. And then, of course, proposed. This is what happens with regard to the increases that happen that he's going to end up with on January 1st. Now, basically, what you're looking here is a strategy map. What do I need to do? Where do I need to go? And to be honest with you, Big Bob may decide, you want to know something? I'm not going to do 44.3. I'm at 36.98. I'm going to go to 41, and I'm going to stay there for the first part of the year. And then going into summer, I may bring it up, but he's planning this out to where he gets to his 44.3 by the end of third quarter. So when he gets into his big season, Christmas season, he's where he needs to be. And it hasn't been big jumps. And this page right here is what allows him to take a look at that and understand what's happening to him. Kevin?
Yeah. So we already discussed this really in terms of trying to assure that you don't have big jumps in your pricing. And once again, that's because you want, that do that by keeping track of what's going on. And if you do need to make some hikes in your rates and your pricing, then, do it incrementally. If you go into a restaurant and you buy a hamburger for $8 and you've been doing that for a year, and then the person that runs the restaurant goes, oh my goodness, I got to raise my prices because I'm not making any money. And they raise it to from $8 to $9.50, you're going to notice that. But if they raise it from $8 to like $8.25, and then they do that again in a couple of months or whatever, it's incremental. So it's a much easier pill to swallow for your customers as well. And if you're keeping track of all this, you're in a position where you can afford to do it incrementally, making these increases rather than just doing it all at once. So just keep that in mind as you move forward with your businesses. Steve.
And this is what it looks like. This is what Big Bob's plan looks like. He's looking at his current sales, his expenses, and his financial position. His financial position basically being his profits. And he's looking at it, okay, this is where it stands today in current. If I go to 44.3% of my margin, this is where it's going to go. And if I continue that through and when I integrate those new increases, and then of course my margin is going to increase my sales price automatically with that increase so that it keeps me even with it. So he's looking at where he is and where he's going to be. And the most important parts of this is looking down at that very bottom line, the net profit or loss margin. Right now, he's at 8%. If he updates it, it'll take him to 32. And then with regard to the increase, you'll notice it's dropping down to 29%, and that's because of the increase on the cost of the unit. Now, there's some red in here. And you want to know something? This is the only place you ever want to see red, and are these two items. Kevin and I, when we're dealing with a new client and they're starting, we talk about what's your break even. In other words, at what point after you open your business do you get to a point in sales where your total sales cover all of your expenses, yet you have no profit yet? That's break even. And as you can tell from Big Bob, right now, he's got to make $22,149 in sales right now to hit break even. When he sells another pair of shoes, after he subtracts the cost of that shoe, that's profit, and it's pure profit. If he goes to 44.3% margin, he has dropped that down to $18,464. And with the new reality on January 1st, it increased a little bit to $19,568. But right now, if he does nothing, he is going to be in a little bit of trouble. He's going to have to hit these costs right here. But he has actually dropped it down $2,500 a month. And that means that's $2,500 a month in profit that he's securing. The other number down here is something that every business owner should know. It's called fixed cost coverage. For a lot of very experienced business owners and entrepreneurs, that number is stuck in their head because every time somebody says, "Oh, well, sorry, but your cost of this is going to go up about $3," they can calculate there right then and there that says, okay, fixed cost coverage, $271. For every dollar it goes up, I have to make an additional $2.71 in sales to come back to break even. Or here's the other part, and this is what entrepreneurs really use it for. They were just offered a pretty good deal on a piece of equipment, and it's going to cost them $5,000. He knows what his fixed cost coverage is, which means he knows what he needs to make in sales in order to pay for it. Very, very useful item. Yep.
So one thing you'll notice on this sheet is at the bottom right-hand side there's a inflation calculator. So there is a couple of exceptions to CPI in which you would need to adjust for inflation. And that is if you're a producer or you sell in-house services, you will need to adjust for inflation. So that's why that inflation calculator is included as part of this tool. So if you fit into one of those categories, that is a tool that you're going to want to take into consideration when you're going through this worksheet.
Real simple to use. We're going to put in, let's say the CPI is 0.9. Yep, 0.09. You see the increases in here. But like Kevin said, most of your CPI from your vendor, coming from your vendors is already factored in. This is in-house stuff. And so it's a tool that not everybody's going to use, but it's there just in case you need it. And so you don't have that big surprise of, wait a minute, I calculated I was going to be here. What happened? No, that's your kind of, that's your safety catch with regard to those hidden expenses that come through. And second to last tab, P&L, profit and loss statement. This one's a little bit different. Normally when Kevin and I see them, each one of these columns here would be either a month or a year or something, and we'd be doing a month over month or a year over year comparison. But for this workbook, it's the standard profit and loss layout showing you this is currently what you're doing. This is what will happen if you update to your industry profit margin. And this is what's going to happen in January with regard to other increases and whatnot. And it's all standard stuff. If you have QuickBooks, you're getting these reports every month. If you don't have QuickBooks, you're doing this on your kitchen cable. This is what it looks like. And these are very easy to build. As a matter of fact, you have one now with this workbook that just lays it out with regard to what is going on in your business. Well, Kevin?
So just keep in mind that if you do this on a monthly basis, that you're actually creating a historical database for your planning for next year. So it is important to keep it up on a month-to-month basis, because once you've completed it at the end of the year, you'll have this data that's available to you to be able to help determine what you're going to do in the following year. So we do urge you to do this on a monthly basis.
And then the last thing is notes and just a couple of reference items. Again, here's the margin versus markup article. If you're new to Excel, though in some of the emails you may have received, you would have seen these links, but they're here in this book. And then annual CPI, you drop it in, and if you put it in for the annual, but you want to adjust for the month or the quarter, it gives you the number. And then your vendor increase calculations. This is all in here. If you hit anything in here, enter anything in here, it doesn't do anything with the rest of the workbook. And to be quite honest with you, it probably took us, we are at 150, we're done. Probably took us longer to go through the workbook than it will be for you to start entering all this information and find out where you are and where you need to go.
Great. Yeah, I'll just add to this. When you look at this and you're listening, I realize there's a lot of information here, and I'll credit Steve with creating this workbook. He is an Excel whiz, in my personal opinion. When I looked at it, I was like, oh, and then I started filling it in, and it all makes perfect sense when you start filling it in. So once you have this workbook available to you and you're able to actually use it, I think you'll find it a great tool to be able to utilize and help you with your business. So.
Thank you, Kevin. And the one thing I just want to add is if you get frustrated with this or anything else, do not put it away and not go back to it again. Get a little frustrated with it, give us a call, and we will sit there and go through it with you. And it is our hope that you'll use this and you'll start seeing parts of your business you never thought were there, or it gives you the opportunity to start building scenarios. What if I do this? What's it going to look like? And then from there, we have other workshops and webinars and whatnot that are a little bit more advanced. And our hope is for you to go from one to the other to the other. The more you know about your business, the more you know how it operates on a financial standpoint, the more successful you're going to be. And the more successful you're going to be, the more you're going to pay in taxes so that we get our grants, and the more people you're going to hire. I hate to sound mercenary, but that's
That's true. That's true. So the other thing is, of course, if you have questions, you can contact us. But once again, Clara's going to be putting this into the archives, and so you will be able to go back and look at it. If you get stuck on, one of the tabs, for instance, you can go back and look at the webinar and say, what did they say about that tab, and view it. So just keep that in mind as well. Mm-hmm. And with that, I'll turn it back over to Clara. Is she available? There she is. Hi, Clara.
Ready and waiting. Just taking in all of the information that both of you have so elegantly and graciously shared with all of us today. Thank you both so much. And yes, Kevin is quite correct. Steve, I will be emailing everyone out in the next couple of hours their very own copy of the workbook, any of the handouts that were mentioned, as well as a link to this recording so you can play it back as many times as delights your heart, so that you can go through the workbook as though Kevin and Steve were right there the whole time. So I want to be mindful of the time. We're almost at the top of the hour. And so what I'm going to do right now is go ahead and share that poll that I mentioned at the very beginning. And while I'm launching that poll, if anyone has any questions or comments that they want to ask or reach out, please feel free to do so either in the Q&A or the chat box. So I've gone ahead and launched that poll, so it should just pop right up on front of your screen there. And if you don't see it immediately, you can check your bottom bar for a poll option, which should have just popped right up. In the meantime, I want to take this moment to thank both Kevin and Steve for, again, putting this together. I know it was a lot of work and you guys made it look like no work at all. Anyone can do it. I could probably even do it. And I do not fondly remember my accounting classes from business school. So if I can do it, you can do it. I promise you. And so great. I see some folks are going ahead and answering the poll already. Thank you all. And if you are not already speaking or seeing a West advisor, I highly, highly recommend reaching out to us. We are here for you, small business owners, entrepreneurs, no matter where you're at in the stage, whether you're just in the planning and idea stage, whether you have been in business for 15, 20, 30 years, we are here to help you however we possibly can, whether you're just starting to get your business online, start a website, getting into social media marketing, whether you need help with your taxes this year. We'll be providing workshops and trainings on all those, but I, again, recommend that you reach out and get in touch with a counselor so that you can get that individual one-on-one assistance. That's kind of what we do here in addition to the workshops.
So two things real quick. This is the first time Kevin and I have done this. So it was hopefully not the last. We will continue to do this one over the next several months. But I want to thank Kevin very, very much. He put a lot of heart and soul in this, and I truly appreciate it. The other thing I want to say is I've gotten 3 texts now from some of my clients that were working on this, saying, "Okay, so when are you going to come over and help me with this?" Well, in the day of COVID. We will Zoom together and share a screen and put your numbers in. No problem.
Great. And I just want to add, I just want to again thank Steve, obviously. Steve is an Excel whiz, and I worked with a lot of people who knew Excel. I know Excel, but he is exceptional. So I'm so happy that we're able to take advantage of his expertise. The other thing I just want to add is this real quick. I know sometimes we have people that join us on these webinars who don't live necessarily in Lake and Mendocino County. And I just want to make sure that you're aware of the fact that there are small business development centers, of which West is one, all over the United States. So there is one in your area, wherever you live. And so you can just look for that resource, and they will have much of the same kind of opportunities to help you and assist with you and so on as we do here at West. So even if you're not in our geographical area, I do want to encourage you to reach out to the Small Business Development Center that is in your area, wherever you are in the United States.
Absolutely. And if you don't know where that is, you can call us anyway, and we'll help you find and get you in touch with them. I've done that so many times already, and we'd be happy to do so. Just before we call it a day, I do want to let both of you know we do actually have a question from Capella. I hope I'm pronouncing that right. Question is, one set of item I sell are pizzas. Would I list each size and type on the individual lines on the worksheet? Thank you for the question. Kevin, Steve?
So that was one of the things I was dealing with this, and that is if you were a hardware store or like Capella, where he's got a great pizzeria up in Willits. Sometimes you just categorize. And so if I'm going to use the hardware, instead of saying I've got 15 different types of nuts that I sell from a little 1/4 inch up to a 1 inch, I'm going to brand them all together, and I'm going to use a price point. And so I'm going to average them together. Now, this is not a scalpel tool. That's what an MBA and a CPA is for. This is for you to know what's going on, and you can make management decisions. So we're going to do some cost averaging and drop those numbers in. So with regard to Capella, it's going to be small pizza, large pizza, and extra large pizza. And there may be some differentiation where he may have 2 or 3 in the small, depending on the price points of them. But he doesn't have to list all of them unless he wants to.
Excellent. Thank you. Sia, thank you for answering my question. I got it. Wonderful. Well, great. If there aren't any other questions, of course, I'll be sharing the email addresses for our instructors today. So if you do want to reach out and ask them any questions privately over email or get in touch, maybe sign up for a counseling appointment, you can absolutely do so. I will be sharing all of that information in our post-workshop email, which I promise to send out later today. So we're just at the top of the hour.
I'm going to say, Clara, thank you very much for your for your assistance. Clara's the behind-the-scenes person that makes all this work, and without her, it would not work, quite frankly, and we'd be flailing about. So thank you, Clara, for bringing order to our chaos. Yes. We appreciate it.
That's very kind. It's a team effort, 110%. Thank you all.
As long as you're there,
right, guys. Yeah, right. Thank you. Bye-bye.
Thank you all, and have a wonderful rest of your day. And I hope to see everyone at one of our next upcoming workshops. Take care. Bye. Bye.